Did you know that gold's price has gone up more than 40% year to date? It has been one of the best performing asset classes year to date, outperforming broad indices such as the S&P 500, which has returned close to 15% year to date, the Nasdaq index, which has returned around 18%, and the ASX 200 index, which has returned close to 10% year to date. So what is really driving this gold rush, and how should you approach it in your portfolio? For centuries, gold has been a safe haven asset that people turn to in times of economic and political uncertainty. And this year's checklist is ticking all the boxes. Tariff wars, record US debt, a weaker US dollar, interest rate cuts, and questions over the Federal Reserve's independence. And now, the US government shutdown. And all of this has led to investors piling into physical gold-backed ETFs, with holdings in September hitting the highest points in the last 3 years. Central banks have been buying more gold too, having bought more gold in the last 4 years than the previous 21 years, as it remains a reliable long-term store of value. Gold's share in sovereign reserves now officially overtaking US dollar the first time since 1996. And all this rush into gold has caused the precious metal to keep setting new highs throughout the year, and as of now, it has just crossed over $3,900 per ounce. Here's the takeaway when you're thinking about portfolio allocation. Diversification is always key, but of course, don't overdo it. Multi-asset funds have typically allocated between 5 to 10% to the precious metal, but remember, there is no one-size-fits-all approach. At the end of the day, it all depends on your risk profile and risk tolerance, and of course, what you are trying to achieve with your investments. Let me know in the comments if you want me to do a deep dive on gold's less talked about, but still very, very impressive sibling, silver.